The markets look strong on the surface, but what if danger is quietly building underneath? Today, we'll break down Doomberg's bold prediction of a crash and commodity chaos. Doomberg is a well-known voice in the financial world, recognized for bold predictions and in-depth market analysis. Recently, they've raised alarms about a potential stock market crash and commodity disruption. These warnings have grabbed investors' attention worldwide, and for good reason. In a rapidly changing economy, staying informed and adaptable is more important than ever. Their influence comes from their ability to decode complex economic signals and spot trends before they hit the mainstream. By understanding Doomberg's insights, investors can protect their portfolios, avoid heavy losses, and make better data-driven decisions. Ignoring such signals could mean missing critical turning points in the global economy. To assess the credibility of these warnings, we must first look at today's economic environment. Rising inflation, volatile energy prices, and geopolitical tensions have made the markets increasingly unpredictable. This uncertainty fuels volatility and keeps investors on edge, questioning when the next downturn might hit. The growing fear of a crash stems from deep-rooted issues: rising interest rates, record-high debt, and weakening consumer demand. Each of these factors can ripple through global markets, influencing both stocks and commodities. Because of this interconnection, trouble in one sector can quickly spark chaos across others. Inflation continues to climb while central banks raise interest rates to contain it. This creates a domino effect: higher borrowing costs, weaker consumer confidence, and slower growth. Meanwhile, political disputes and trade barriers only intensify global economic strain, adding more pressure to the system. When we analyze all these moving parts together, the housing market, employment rates, and global supply chain disruptions, it becomes clear that the situation is fragile. Understanding these relationships helps investors see potential risks before they become reality and spot opportunities during uncertainty. In today's interconnected world, financial awareness is everything. Staying on top of global trends, policy changes, and market data allows investors to anticipate rather than react. Doomberg's work serves as a reminder that preparation is the best form of protection in turbulent markets. Among the warning signs Doomberg emphasizes, inflation and interest rates stand out. If both continue climbing, the risk of recession and declining asset prices grows significantly. Such economic tightening can dry up liquidity, slow business investment, and lower consumer spending. Interest rate hikes don't only affect stock prices, they also influence commodities. Higher rates strengthen the dollar, which often pressures commodity prices downward. This chain reaction can harm economies dependent on exports and raw materials. Geopolitical tensions like trade wars and energy disputes add another unpredictable layer. When global powers clash, it disrupts production, supply, and shipping, often leading to sharp price swings and reduced investor confidence. Another key concern Doomberg highlights is ballooning global debt. When debt reaches unsustainable levels, economies become vulnerable to shocks. A small disruption can trigger massive sell-offs or liquidity crises, amplifying volatility across markets. Historically, the yield curve has been one of the most reliable warning signs of recession. Doomberg points to recent inversions as a red flag. When short-term interest rates exceed long-term ones, it signals declining confidence in future growth, a potential setup for a downturn. Currently, the global economy stands on a tightrope. Inflation, debt, and geopolitical risks all feed into the same problem: uncertainty. Doomberg's warnings remind investors that the margin for error is shrinking and proactive risk management is crucial. Doomberg predicts that we're nearing a major economic turning point. They warn that investors should brace for both a market crash and potential commodity turbulence. Whether that happens soon or gradually, their message is clear: preparation beats panic. Their analysis isn't fear-mongering, it's a call for strategic thinking. By studying these economic signals, investors can shift towards safer assets, diversify portfolios, and minimize exposure to unstable markets. But Doomberg's warnings aren't just about fear, they're about opportunity. Crashes often reset valuations, allowing disciplined investors to buy strong assets at discounted prices. Those who stay calm, informed, and patient can often emerge stronger after downturns. It's also important to consider behavioral economics. During uncertain times, investor emotions like fear and greed can magnify market movements. Understanding these psychological triggers helps investors avoid impulsive decisions and stick to long-term plans. Another factor often overlooked is technology's role in market reactions. With algorithmic trading and AI-driven investments, market swings can happen faster than ever before. Monitoring these dynamics is key to staying one step ahead. Energy markets, especially oil and gas, play a critical role in this equation. Fluctuations in energy prices directly affect transportation, manufacturing, and food costs, creating ripple effects across the global economy. Investors should also focus on diversification, not just across stocks and bonds, but across regions and sectors. Holding assets in emerging markets or commodities can provide balance when traditional markets fall. Lastly, preparation doesn't mean pessimism. Building cash reserves, cutting debt, and investing in knowledge can all strengthen your financial resilience. Whether Doomberg's predictions come true or not, smart planning will always pay off. In conclusion, Doomberg's warning about a potential market crash and commodity chaos deserves attention. The combination of inflation, debt, and geopolitical risk creates a volatile environment that can shift quickly. The main takeaway is simple: vigilance is not fear, it's strategy. By paying attention to credible analyses like Doomberg's, investors can protect their wealth and even find opportunities in times of uncertainty. Yes, the situation is complex, but knowledge and preparation turn uncertainty into advantage. Stay alert, stay informed, and keep learning because the next financial wave may already be forming. If you found this discussion insightful, share your thoughts below. And don't forget to check out our next video, where we dive deeper into how global events shape future market trends.